This accounting mini lecture covers the ratios working capital, current ratio, and the acid test ratio. All of these ratios are considered to be indicators of liquidity. Now, remember, liquidity focuses on a company's ability to satisfy their short-term debts. We want to know if a company has substantial assets and whether they will be able to generate substantial cash in order to pay their debts as they become due on a short-term basis. Now, working capital, we're going to compute by taking our current assets minus our current liabilities. That gives us working capital. Now remember, all of this information will be contained on a balance sheet. A balance sheet should tell us both our current assets and our current liabilities, which enables us to easily compute the working capital. Current ratio is very similar to working capital, except this time, instead of taking current assets minus current liabilities, we're going to take current assets divided by current liabilities. Let's look at an example. Here we can see our current assets and our current liabilities for 2007 all the way through 2012. And you'll see that we've used the current ratio formula in order to compute our current ratio. Now, generally speaking, the higher a company's current ratio, the better able that company is going to be in terms of being able to satisfy their debts as they become due. For example, we see the highest ratio was in 2010. In 2010, the company had current assets of $3,250 and only had current liabilities of $1,322. So generally speaking, we would be able to assume that this company has plenty of assets to cover those current liabilities. When we see a current ratio fall below 1, that's when we really have to get concerned, because if the current ratio falls below 1, then what that means is we have more current liabilities than we have current assets. So at some point, that company could run into some real trouble in being able to pay their debts and pay those bills as they become due. Now, we can see also in this table, they've also compared this company to the industry average current ratio. This is something that analysts will often do. We can go to financial websites and obtain industry average information. So sometimes it's interesting to see how a specific company is performing in comparison to others in their industry. Now, the acid test ratio is similar to the current ratio, except it's a little bit more conservative, okay? With the acid test ratio, we're not going to include all current assets. We are only going to include our quick assets, which are basically our very liquid assets. This is going to include cash, short-term investments such as marketable securities, and receivables. We then take those quick assets and divide by current liabilities. Now, the purpose of the acid test ratio, if you'll notice, the primary current asset that has been left out of this formula is inventory. And generally speaking, inventory is not considered quite as liquid as some of our other current assets. So again, that's why the acid test ratio gives us a little bit more of a conservative measure of how liquid we are. What sort of current assets do we have that can be easily liquidated in order to pay our short-term debts? Thank you for watching this video on working capital, current ratio, and the acid test ratio.